Hi everyone, I'm Conrad Ford. I'm the Chief Products and Strategy Officer at Allica Bank. Allica Bank is a digital bank focused on what we call established SMEs. And fun fact, we were officially named the fastest growing fintech ever in the UK recently by Deloitte. So I think it's really important to note that firstly, what we've actually faced from an interest rate perspective in the last couple of years was a return to normal interest rate environment. So the kind of almost zero interest rates we had for 10, 15 years, that never happened before in the recorded history of the Bank of England. And of course, the recorded history of the Bank of England goes a very long way back. So we've seen a return to normality. Of course, certainly here in the UK, interest rates seem to have plateaued, and if anything, they're going to be going downwards, thanks to the data seems to show. So I think a lender that's not designed for a normal interest rate environment is not a lender. Let's be clear about that. They're not really a lender. But how should lenders be thinking about this? Well, I think what we'll see with the return of normal interest rates is a return of the normal pecking order in lending. Historically, you would think about very big banks at the top of the food chain, tier one as the industry calls it, and then in the middle, tier two, the challenger banks, and then the non-bank lenders. Those kind of began to merge a bit during the low interest rate environment or zero interest rate environment that we had. Now we're seeing a return to normality, and I think it's about finding your place in the credit risk curve. It's what it's all about. Yeah, so I think there's been a lot of focus in the last 10 years on using new data sources cleverly at origination, so better credit risk scoring, for example, and better pricing. Perhaps not as much investment on the monitoring side, but in the current environment that we have, I think that's incredibly important. So how are we thinking about this at Allica Bank? Well, there's actually tons of publicly available data about our customers. Our customers are established medium-sized businesses. There's lots of publicly available information, whether it's their company's house filings or whether it's the information on their website. So how do you use those data sources to stay close to your customers so that you can be there and you can step in if things are, if they seem to be struggling, if there's any signs of you can be there, you can get in there quickly, you can help them. So thinking about monitoring and how you can use data to monitor your portfolio, I think is a really big deal at the moment. So it's been an extraordinary few years for anyone in the lending community. You kind of run out of superlatives. So let's just list it. We've had the highest inflation in decades. We've had the biggest pandemic in decades. We've had the fastest interest rate rise in decades. And right now that's beginning to flow through in terms of lending metrics. So we also have the highest insolvency rates, for example, in decades in the UK. So it kind of feels as if we've been through wave after wave of challenge. And really our models are being tested to destruction at the moment, aren't they? It's been a challenging period, but I think the good news is that the borrowers have turned out to be surprisingly resilient. Now we haven't seen huge spikes in consumer lending, for example. Well, not that I'm aware of. Certainly in business lending where I operate, I think the general sentiment in the industry is that SMEs have turned out to be surprisingly resilient. We shouldn't underestimate their ability to take their own actions to deal with the environment that we're operating in. To make cost reductions, to change their spending plans, to slow down their investment plans. I think we're seeing that playing out in surprisingly steady rate of defaults. Well, I mean, given all the things that have happened over the last few years in terms of pandemics, interest rate rises, inflation, etc. I'm very reticent about making forward-looking statements, but with that caveat, it does look like the trend of interest rates, if anything, is down, and that will, obviously take some of the pressure off some of the lenders for whom that's a different, challenging environment, and of course take some of the pressure off borrowers and actually allow higher affordability. So I think interest rates, if they begin to trend downwards, and I think the balancing probability is that they will, certainly during this year, then I think it will be a period when, two things will happen. Firstly, it will take some of the pressure off lenders, but also I think we'll see a return of borrower appetite. So for example, in our world of SME, it's pretty clear to me that lots of businesses have very deliberately slowed down their investment plans as they've dealt with the uncertainty of the last few years. There's no reason why you can't stretch another 2 or 3 years out of a van or a truck. So why would you invest in a new one if you're uncertain, I think we're beginning to see a bit of return to animal spirits, because the borrowers are thinking interest rates are certainly not going upwards, they think. And at the same time, we seem to have dodged a major recession as well. So I think we're seeing a return of a really healthy lending environment, I hope. The most exciting thing that's happened in lending from a technology perspective over the last few years for me has certainly been around just unearthing new sources of data. In our world of SME lending to sort of medium-sized businesses, it's really quite surprising how much information is available about our customers if you know where to look and are willing to look. So I think the exciting thing is better use of data. And that's a really positive thing for both sides of the equation, by the way, because it's in everybody's interest that we we lend less to businesses that can't afford to pay it back and more to those that can. It's good for the economy as well, because it will drive better investment in the economy. So I'm very excited about that. The other thing I'm really excited about is that I think we're seeing growing specialisation in the lending segment. So if you look at the SME lending segment, for example, when I set out in this sector 15 years ago, it was just taken as read that the big banks utterly dominated lending to SMEs in the UK. Utterly dominated, depending on which metric, 80–90% market share. Believe it or not, that has changed markedly in the last 10 years or so. And now the majority of lending to SMEs in the UK is by specialists and challenger banks. So we've seen a complete upending of the market. And I personally would not believe that things were going to happen that quickly. And that's good news for everybody, right? Because frankly, the big banks don't want that huge weight on their shoulders of lending to every SME in the UK. But at the same time, it means you've got a growing number of specialist lenders who are really dedicated to particular types of lending. So for example, there's one bank in the UK that's exclusively focused on agricultural businesses. So I think it's a really positive thing, because we've got more and more specialist lenders, and that means that customers will be better served by lenders that are focused on their particular needs. So that excites me too.